Good afternoon. The United States struck Iran for a second straight day, about 90 targets along the coast, and the whole tape is now trading off one waterway, the Strait of Hormuz. Oil carries a war premium, the 30-year Treasury is above 5%, and here is the split that tells the story. The Dow fell almost 600 points while the Nasdaq actually rose. That is not what fear looks like. In a real panic, money floods into treasuries and yields fall. Today yields went up. This is being priced as an inflation and rates shock, not a flight to safety. Let's get into it. Here's the board. The S&P is off 0.3%, the Dow down about 577 points, more than 1%, but the Nasdaq is actually up 0.2, holding on the artificial intelligence names. Brent crude is easing near $77 after Wednesday's 5% spike. Gold is roughly flat near 4,090, capped. Bitcoin is down near 62,400. Now the number that matters most. The 10-year Treasury yield is 4.59%, its highest since May, and the 30-year is above 5%, with demand thinning. Long bonds are being sold into a shooting war. That is the whole tell. This is an inflation shock, not Armageddon. Now the signature segment. Consensus versus the read. First. Everyone thinks the artificial intelligence trade just broke peak mania. The tape says the sell-off was plumbing, not a thesis break. Chip names sold off on mechanical flows, roughly $1 trillion of index and pension rebalancing after the second quarter semiconductor run, plus a rumored hedge fund pod being force liquidated. Not one new fact about demand. And here is the tell that cuts the other way. SK Hynix's United States share offering was oversubscribed the same week. If artificial intelligence memory demand were actually cracking, that book does not fill. Crowded is not the same as wrong, high conviction. Second read, and this is today's deep dive. Everyone thinks the record Bitcoin exchange-traded fund outflows mean the institutional moment failed. The money leaving is not leaving, it is upgrading. United States Bitcoin funds bled a record $4.5 billion in June, and retail read it as capitulation. But BlackRock's IBIT now holds about 765,000 Bitcoin, 61% of the entire fund sector and roughly 74% of daily volume, while BlackRock stood up a staked Ethereum fund, a covered call Bitcoin product, and a $2.5 billion tokenized treasury fund. The cheap fund is losing money that quietly reappears in the higher fee stack. Wall Street is not abandoning crypto. It is building the toll booth, high conviction. Third read, everyone says Grok 4.5 is the new #1 model. It is #1 on the vendor's own scorecard. This week XAI shipped Grok 4.5 and Cognition shipped a rival coding model within 24 hours, both leading on cost per capability. That vector shift is real and it matters. The frontier fight has moved to cheap, fast, agentic coding. But the #1 on benchmarks claim is self-reported. No independent leaderboard has confirmed it. So trade the capability trend and discount the grade until a neutral third party scores it. Medium conviction on the ranking, higher on the trend. Here is the tell, the single most revealing data point of the day. In a classic risk-off event, money floods into long treasuries and yields fall. Today they rose. The 10-year is 4.59% and the 30-year is above 5%, with thinning demand at the long end, while equities wobbled and the Dow got hit hardest. That one divergence tells you the market's dominant fear is not recession, and it is not war-driven flight. It is oil-fed inflation forcing the Federal Reserve to stay tight. When the safety asset sells off during the exact event it is built for, believe the bond, not the headline. Follow the money. The macro regime is one feedback loop right now. Oil, into inflation, into higher for longer, into everything long duration under pressure. The Hormuz premium rearmed the inflation tail exactly when the market wanted to price cuts. So the July 29th Federal Reserve meeting is genuinely two-sided. Futures price about a 1 in 3 chance of a hike, with nearly half the market positioned for more than one this year. But the pros who watch the barrel argue those odds are fading, because Gulf, Venezuelan, and Colombian barrels are rerouting around Hormuz at a toll rather than vanishing. Their frame, oil settles in a $70 to $80 band, not a $138 rerun, unless the strait actually closes. Gold is the quiet tell of the whole regime. Spot sits near 4,090, opening lower each day this week. capped in the near term by rising real yields, which climbed from about 2% to 2.3% through the second quarter and mechanically pressured gold off its highs. But the structural bid keeps compounding. Bernstein just lifted its 2026 gold target to $4,533, and central banks have made gold their #1 reserve asset, ahead of treasuries. That is the debasement trade in one line, pressured by the cycle, bid by the structure. On sentiment, our market and social monitoring shows heavy stablecoin minting this window, fresh, dry powder loaded on the sidelines, even as the mood splits sharply bull versus bear. Sectors in play: energy is the one sector the tape rewards today. The Hormuz premium is a direct tailwind, and the risk is asymmetric to the upside on a genuine straight closure, range-bound otherwise. Own the risk premium, size for the range, not the panic. Semiconductors sold on mechanical flows, not demand, and SK Hynix's oversubscribed offering says memory is still hot, so the wobble is a crowding reset, not a cycle top. And crypto. Separate the coin from the rails. The institutional plumbing, the BlackRock fee stack, the clearinghouse pilot with more than 50 firms, JP Morgan's 800 million tokenized on Ethereum, PayPal's stablecoin live on Polygon, all of it compounds regardless of what Bitcoin does today. On the radar, first, the Strait of Hormuz. Renormalization versus a genuine closure is the switch between an oil range and an oil spiral, and the whole tape hangs on it. Next week, big tech earnings and hyperscaler capital spending guidance, the artificial intelligence trade's real test after today's mechanical wobble, with more than $700 billion of capital spending under the microscope. July 29th, the Federal Reserve. A live 1 in 3 hike with oil-driven inflation as the swing variable. And August 7th, the Crypto Clarity Act, where the Senate has about 20 working days before recess. Passage is the catalyst. Failure is another stall. For the scorecard, 3 new calls on the record. 1. The institutional plumbing thesis. Over the next quarter, BlackRock's IBIT holds or grows its 60% plus share of Bitcoin fund assets even if aggregate flows stay weak, and the tokenization rails keep expanding regardless of the spot price. 2. The artificial intelligence wobble is a crowding reset, not a top. Chip names recover the bulk of this week's mechanical drawdown, and memory does not lead a demand-driven collapse. And 3. Grok 4.5's #1 claim does not survive independent scoring within 30 days. We date them and we grade them, and prior calls are holding. The 10-year has not broken below 4.35, Brent has not held above 80, and Bitcoin is holding its range. So here's the question worth sitting with. If the market's real fear were war, long bonds would be a haven and yields would be falling. They are rising, so the thing to watch is not the next headline out of the Strait. It is whether the bond market keeps telling you this is about inflation or flips and starts telling you it is about growth. The day the 10-year breaks toward 4.35 instead of 4.75, the whole trade changes. Until then, the tape is doing exactly what an inflation shock looks like, and the edge is in believing the bonds, not the panic. That's the daily brief. Today's deep dive is linked right below. This is Earl, one contrarian read a day. Subscribe.